What if I told you the modern economy is like a bicycle, and debt is the forward motion? Not the crash, not the rust, not the squeaky chain, the motion. Because the moment the bike stops moving, everybody starts panicking. Banks panic, businesses panic, governments panic. Markets start sweating like a man who just got asked, "So, what exactly do you do here?" We've been taught to think of debt as a villain, a monster, a trap, a financial demon hiding under the mattress with your credit card statement. And on the personal level, yes, debt can absolutely wreck lives. But on the level of the modern economy, debt is not just common, it is not just useful, it is not just tolerated, it is structural. Because here's the counterintuitive truth. Modern economies do not merely use debt, they are built on it. And if you rip debt out too fast, you do not get freedom, you get collapse. Today, we are going down the rabbit hole of why economies need debt to function, why money itself is tangled up with borrowing, why everyone paying off all debt would be a disaster, and why the machine always seems hungry for more credit. This is not a conspiracy bedtime story. This is balance sheet reality. And once you see it, you cannot unsee it. The word debt has a PR disaster. Let's start with the emotional problem. When people hear debt, they think late notices, student loans, credit cards at 27% interest, a banker smiling too hard. And that reaction makes sense, because for households, debt often feels like a chain around tomorrow. But in macroeconomics, debt is something else. Debt is also mortgages financing homes, business loans financing inventory, payroll, and expansion, government bonds financing spending before tax revenue arrives, and bank lending that helps create much of the deposit money people actually use. So the first twist in the story is this. Debt is not merely a burden, it is also a coordination technology. It allows the future to fund the present. A farmer borrows before harvest, a company borrows before profits, a government borrows before taxes come in, a family borrows before they can save enough to buy a home. Debt says, I believe tomorrow's income can justify today's action. That can be reckless, but it can also be civilization. Because without that bridge between present and future, economic activity becomes smaller, slower, and far more limited. No bridge, no leap. No credit, no scale. No debt, no modern system. The shocking part, much of money is born as debt. Now we get to the part that makes people sit upright. Most people imagine banks as vaults. You deposit money, the bank lends some of it out, like a polite middleman moving your cash from point A to point B. That story is simple. It is also deeply incomplete. The Bank of England explains that in the modern economy, most money exists as bank deposits, and commercial banks create those deposits when they make loans. In plain English, bank lending creates new deposit money. Banks are not simply lending out pre-existing deposits in the old cartoon version people imagine. Read that again slowly, because this is where the rabbit hole opens. When a bank makes a loan, it typically creates a matching deposit. Loan on one side, deposit on the other, an asset for the bank, a liability for the bank, new purchasing power for the borrower. That means a huge share of the money sloshing around the economy is connected to somebody's debt. So, if you ask, why does the economy need debt? Part of the answer is because in the current system, debt creation and money creation are closely linked. This is where some viewers will stare into the distance like they just realized the house cat pays no rent. The modern economy runs on money. Much of that money enters circulation through credit. Therefore, the economy leans on debt not as an accident, but as a mechanism. That does not mean all money is debt in exactly the same sense. Cash is different. Central bank reserves are different. Government money and private bank money are not identical. But in day-to-day life, the money most people use is overwhelmingly bank deposits, and those deposits are heavily shaped by lending. So yes, the system is stranger than the school textbook. Why an economy without debt would be tiny? Imagine a world with no borrowing, no mortgages, no business loans, no municipal bonds, no venture debt,
No government bond market, no working capital loans, just cash on hand. Want to build a factory? Save for 23 years. Want to buy a home? Start in kindergarten. Want to launch a company? Good luck selling enough cupcakes to fund a semiconductor plant. Debt allows large, expensive, productive things to happen before the total cash already exists in one place. That matters because production is lumpy. Infrastructure is expensive. Growth takes time. Projects require front-loaded costs and back-loaded returns. Debt compresses time. It lets societies act on future capacity now. That is why sovereign debt can play an important role in financing investment and development, even though it must remain sustainable. The IMF is explicit that public debt is an important way for governments to finance investments in growth and development, but excessive or unsustainable debt can become dangerous. So the mature view is not debt bad, cash good. The mature view is debt is a tool, useful in the right quantity, catastrophic in the wrong quantity, like fire or caffeine or a group chat with no exit button. Why growth makes debt feel necessary. Here's where the machine reveals its appetite. Modern economies are built around expectations. Next quarter should be bigger than this quarter. Employment should hold up. Loans should be serviced. Pensions should be funded. Asset prices should not implode. Governments should roll over old debt. Businesses should refinance. Consumers should keep spending. That entire architecture assumes motion, and debt helps create that motion. Credit funds spending. Spending becomes someone else's income. Employment supports more borrowing and spending. This can become a virtuous cycle. It can also become an unstable loop. Because once a system becomes accustomed to credit-fueled expansion, the absence of new debt can feel like oxygen leaving the room. Banks' balance sheets expand when loans are created faster than they are repaid, and deposit funding shrinks in the opposite case. The BIS notes that banks generate transaction deposits by extending loans or acquiring assets, and those deposits are destroyed when debt is repaid. That's huge because it means debt repayment can actually reduce deposit money in the banking system. So, if everyone suddenly became ultra-disciplined financial monks and paid down debt aggressively all at once, that wouldn't create utopia. It could create a contraction, less lending, less money creation through bank deposits, less spending, more defaults, falling asset prices, layoffs, panic. That's the irony. What feels morally healthy at the individual level can become economically destabilizing at the aggregate level if it happens too abruptly and universally. The economy says, please be responsible, but not all at once, apparently. Governments need debt for a reason, too. Now let's talk about the biggest borrower in the room, the state. People often ask, why can't governments just live within their means? That sounds sensible until you realize governments don't receive all taxes before spending needs arise. Wars happen before the bill is fully funded. Recessions hit before revenue recovers. Roads, ports, power grids, hospitals, and public systems often require large upfront expenditure. Government debt solves a timing problem. It allows spending to happen now while repayment is spread over time. In theory, that can be rational if the borrowing supports stability, productivity, or crisis response. In practice, it can also be abused. But again, the key truth is not that debt is evil. It's that without government bond markets, modern fiscal systems become far less flexible, and central banks themselves rely heavily on government securities in monetary operations. The Fed explains that open market operations involve purchases and sales of securities as a core policy tool, and central bank operations interact closely with government debt markets. In other words, government bonds are not some side hobby. They are part of the plumbing, not the wallpaper, the plumbing. And you only ignore plumbing until something starts leaking through the ceiling. The whole thing runs on trust. Now we descend one layer deeper. Debt only works if people believe repayment is plausible. That means the system is not merely built on math. It is built on trust. You trust the bank deposit is money. The bank trusts the borrower will pay. Investors trust the government bond will be honored. Markets trust the central bank can stabilize liquidity when stress erupts. The BIS describes modern money as part of a two-tiered system. The public uses commercial bank money, while banks settle with central bank money. That arrangement only functions because the liabilities involved are broadly trusted. So, debt is not merely numbers in spreadsheets. It is institutionalized confidence, a giant social agreement that claims on the future still means something today. And when that trust weakens, the machine convulses. Credit dries up, liquidity vanishes. Everybody suddenly becomes an expert on counterparty risk after having ignored the term for 19 peaceful years. A debt-based economy is like a theater production where every actor is holding up scenery for the others. As long as everyone keeps holding, the castle looks magnificent. But if too many hands let go at once, surprise, the
King was standing in drywall. Why the system always wants more. Here comes the uncomfortable question. If debt is necessary, does that mean the system always needs more debt? Not exactly, but it often leans that way. Why? Because existing debt carries obligations, interest payments, refinancing needs, rollovers, growth expectations, asset valuations based on future cash flow. That means the system often depends on continuing income growth and continued access to credit. If income growth slows while debt loads remain high, the burden gets heavier. If refinancing gets expensive, stress emerges. If rates rise sharply, yesterday's manageable debt can become today's financial horror movie. So economies often seek a delicate balance. Enough debt to keep activity moving, not so much debt that repayment confidence breaks. That tension is permanent. It is why central banks exist, why fiscal debates never end, why recessions hurt, why financial crises look like slow denial followed by very fast mathematics. The lesson is not borrow infinitely. The lesson is a modern economy without debt is hard to imagine. A modern economy with too much debt is easy to imagine. We live in the tension between those two truths. The Great Paradox. Let's summarize the paradox like a storyteller standing in front of a bonfire. Debt helps create money. Debt helps finance growth. Debt helps smooth time. Debt helps governments function. Debt helps firms expand. Debt helps households buy major assets. And yet, too much debt can strangle growth. Too much debt can make the system fragile. Too much debt can trigger banking crises, sovereign crises, inflation pressures in some contexts, or brutal deflationary busts in others. The IMF is explicit that while public debt can fund growth and development, debt burdens must remain sustainable because debt distress is painful and destabilizing. So debt is both fuel and fire hazard. It is the ladder and the loose rung. It is the engine oil and, in excess, the oil splick. Which means the real economic debate is not should debt exist. That debate is over. Debt exists everywhere in the architecture. The real debate is who should borrow, how much, for what purpose, at what cost, under what constraints, and what happens when repayment assumptions meet reality. That is the grown-up conversation. Everything else is bumper stickers. The human version. Now bring it back down from central banks and sovereign bonds to the human level. Why does this matter to ordinary people? Because once you understand that the economy is structurally tied to debt, you stop asking childish questions like, why don't they just eliminate debt? And you start asking sharper ones. Why is productive debt treated the same as predatory debt in public conversation? Why are asset bubbles allowed to feed on cheap credit?
Why do housing markets become addicted to leverage? Why do governments rely on borrowing instead of cleaner tax and spend transparency? Why do we celebrate growth even when it is financed by fragility? Now you're asking dangerous questions, the useful kind. Because the truth is, not that debt is optional and we foolishly chose it for decoration. The truth is that modern scale, liquidity, and growth have been built on layers of promises about the future. Debt is one of those promises, and the system works until promises outrun reality. So here is the counterintuitive truth. Modern economies need debt to function because debt is woven into money creation, investment, government finance, and the timing of economic life itself. Debt is not just a parasite feeding on the system. In many ways, debt is part of the system's circulatory flow. But every system built on promises lives under one permanent warning. Promises must eventually meet production. Credit must eventually meet cash flow. Hope must eventually meet reality. That is the drama of every economy. Not whether debt exists, but whether the future arrives rich enough to justify what the present has already borrowed from it. And that, my friends, is why the machine never talks about debt like a moral issue alone. Because to the machine, debt is not merely sin. It is oxygen, potentially explosive oxygen, but oxygen. The next time someone says, "Why doesn't the whole world just get out of debt?" Tell them, because if the entire modern economy tried to slam that brake at once, it wouldn't look like liberation, it would look like a stall. And in a debt-based system, a stall is where the real panic begins. If this changed how you think about money, banking, and the hidden plumbing of the modern world, subscribe. Because this channel is not here to give you cartoon economics. We're here to open the machine, point at the gears, and say, look, that part everyone ignores, that part runs everything. Comment below. Is debt the engine of prosperity or the elegant trap underneath modern civilization? And for the next episode, we can go even deeper. What happens if credit stops expanding? Because that story gets darker.